Welcome to The Deep Dive, the show where we slice through the noise of earnings season, the calls, the reports, all of it, and get right to the actionable insights. This is Talk Tickers, and today we are jumping straight into the Q3 fiscal year 2026 earnings for Snowflake, tickers SNOW.
And you really have to set the stage for this one. I mean, heading into the call, expectations were just sky high. The stock had surged, something like 70% year to date, all on this huge excitement around their AI data cloud pivot.
Right, so you immediately had this massive disconnect. The numbers looked great, management sounds super confident, but the market's reaction after the release was, well, it was not good.
It was cautious, to put it mildly. We saw a pretty big drop, so that's the mission today. Figure out why a clear beat led to a sell-off.
Okay, so let's start with the headline numbers, just the facts for Q3. What did they report?
Well, looking purely at the results, they crushed it. Total revenue came in at $1.21 billion. That beat the street's consensus of $1.18 billion, so a solid 2.7% beat right there.
And the really important one, product revenue.
That's the key metric. It hit $1.16 billion, which is 29% growth year over year. Very strong.
And the profitability story just gets even better, right? I'm looking at the EPS.
Oh, yeah. Non-GAAP EPS was 35 cents. The consensus was looking for 31 cents. So that's almost a 13% upside surprise. And get this. It's 75% growth year over year.
So if you stop reading right there, you'd think, okay, the stock's up 10, maybe 15%.
You would assume that. Instead, after hours, it was an immediate and clear move down. It settled about, 7.5% to 8% lower. And that tells you everything. The story isn't in the headlines. It's in the guidance and the core metrics.
Okay, so let's dig in there. Let's start with the fundamentals of the business, because these metrics are, frankly, best in class. They tell a story of really durable growth.
It's fascinating, right? You look at something like net revenue retention, or NRR. That tracks how much your existing customers from a year ago are spending today. It held steady at 125%.
125. For a company at this scale, that means your baseline customers are just organically growing their spend by 25% every year. That's an incredible engine.
It's extremely rare. And you pair that with their long-term visibility, we have to talk about RPO.
Remaining performance obligations.
Yeah.
So this is the backlog. This is money that's already been committed in contracts.
Exactly. And the RPO number, it accelerated this quarter. It hit $7.88 billion. That's 37% year-over-year growth.
Wait, hold on. Let me just stop you there. So current revenue is growing at 29%, but their committed future backlog of revenue, it's accelerating at 37%. Shouldn't the market see that as the single most important signal? Isn't that the whole story?
That is the central tension of this entire call. That's the disconnect. Management clearly believes that RPO number is the key signal. Customers are signing bigger, longer deals. They said Q3 was a record quarter for large deals. They signed 4 separate contracts, each worth over $100 million.
9-figure deals. Okay, so these aren't small test projects. These are massive strategic commitments.
Exactly. And you see it in their large customer count, too. They added 688 customers who spend over $1 million a year with them. That cohort is up 29%.
And this isn't just growth for growth's sake. It's profitable.
Very profitable. Non-GAAP operating margin expanded to 11%. That's over $180 million in operating income.
Which flows right down to cash, right? Adjusted free cash flow margin was also 11%.
Yeah.
So they're generating real cash at scale, which is so important because it lets them fund this massive push into AI.
It's the whole flywheel. That cash funds the strategy. And the core of the strategy right now is the AI data cloud. The CEO, Sridhar Ramaswamy, he was very clear. He framed Snowflake as, quote, the cornerstone for our customers' data and AI strategies.
And they actually hit a huge AI milestone this quarter, and they hit it early.
They did. $100 million in an AI revenue run rate.
And that's based on actual consumption, right? This isn't just bookings or hype, it's real usage.
That's the key. This is real enterprise money being spent on AI workloads right now. And a lot of that is being driven by what they're calling Snowflake Intelligence. They said it's the fastest ramping product in the company's history.
And that enables this agentic AI concept. For those who haven't heard the term, what does that really mean?
It's basically AI that can act on its own. It can string together multiple complex tasks without a human needing to step in at every single point. They said 1,200 customers are already using it.
And they gave a really powerful, specific example.
They did. TS Imagine. They built an AI agent on the platform that handles tasks equivalent to 8.5 full-time employees. I mean, that is a quantifiable hard dollar ROI that you can take to any CFO. That's what sells enterprise software.
Wow. And they're not just building this stuff in a vacuum, they're backing it up with some major partnerships.
Huge ones. They announced a $200 million multi-year deal with Anthropic. They're embedding the Claude models directly into Snowflake. This is so important. They're becoming the orchestrator, not the model builder.
Right, they're the platform. And they're also locking down the go-to-market with the Accenture deal.
Yeah, that one stood out. Accenture is committing to train over 5,000 of their people on Snowflake. So when a big company wants to do Gen AI, the consultants they hire will be trained to build it on Snowflake. It just removes all the friction.
And they're making smart little acquisitions, too, with Datometry and Selector.
Right. They're using their cash flow to smooth out any bumps in the road for customers. Datometry is all about making it easier and faster to migrate off old legacy databases. And Selector is about improving the data catalog for AI. The message is, we're making the platform unified and ready for this next wave.
Okay, so let's put it all together. The financials are pristine. RPO is accelerating. Profitable growth is there. AI adoption is happening faster than planned. So why the 8% drop? It all has to come down to the guidance.
It's 100% the guidance. The market focused like a laser on the Q4 product revenue guide. Management guided for between 1.195 and 1.2 billion. That represents 27% year-over-year growth.
Okay, so to an outsider, 27% growth at this scale sounds incredible. They even raised the full-year outlook. So why did that number spook the market?
It's all about market psychology and the valuation multiple. Remember, the stock ran up 70%. Investors had priced in not just strong growth, but accelerating growth. A lot of people were hoping for a guide north of 30%.
So the 27%, even though it's a huge number, signaled a slight deceleration.
A deceleration in the magnitude of the beaten race. That's the key. Last quarter, their guide beat consensus by almost 5%. This quarter's Q4 guide only beat by about 2.3%.
That's a very subtle difference to cause an 8% sell-off.
It is. But that's the game when you're trading at a premium multiple. The street saw that smaller beat as a sign of weakness. Management is pointing to the 37% RPO growth as the real story, but the market is focused on the immediate consumption number.
It's long-term conviction versus short-term impatience, which of course brings us to the trade dynamics around all this.
And this is where we have to put up the big, bright, flashing lights.
Yes. This is not financial advice. We're simply exploring a hypothetical trade idea based on the dynamics we've discussed. Please do not trade off this commentary.
Understood. Okay. So, given that massive drop, despite the fundamentals, you could look at a relative value trade here, one that capitalizes on what looks like a behavioral overreaction to that Q4 guide.
Okay, so an 8% dip on a company whose committed backlog is growing at 37%. What's the play?
You're betting on the long-term story over the short-term fear. The proposition is something called a long-short basis trade. It sounds complicated, but the idea is simple. We're selling the market's panic to pay for a long-term bullish bet.
Okay, break that down for us.
Step 1, you initiate a core position. You buy S&OW shares on this 8% dip because you believe in the fundamentals. Now, step 2, that fear in the market makes short-term put options, the right to sell the stock lower, really expensive.
Okay.
So you take advantage of that. You sell those expensive short-term puts, maybe the ones expiring in Q4. You collect that cash, that premium.
So you're essentially getting paid to say, I don't think the stock is going to fall much further from here in the short term.
Exactly. You pocket the cash from the market's fear, then you take that cash and you use it to buy a long-dated call option, something that gives you upside exposure way out into the future, maybe expiring in fiscal year 27.
So you're using the money generated from selling the short-term panic to finance a long-term bet that the RPO and AI story will win out over the next year or two.
That is the trade. You're using the high implied volatility today to fund a bet on a structural rebound tomorrow. The bet is that by FY27, consumption will reaccelerate back towards that low 30s growth range, and the profitable compounder story will be back in full force.
That's a fascinating structure. It really captures the entire tension of this earnings call.
So for you, the key takeaway is pretty clear. Snowflake is still a core AI data platform with just exceptional metrics. 125% NRR, 37% RPO growth. AI is ramping ahead of schedule, but the stock just got ahead of itself.
When you run up 70%, the market moves the goalposts. Great isn't good enough anymore. You need perfect acceleration.
And 27% growth is suddenly viewed as a slowdown. So final provocative thought I'll leave you with is this. Is this post-earnings drop just a necessary healthy reset in expectations after a huge rally? Or is that 27% guide a real structural signal that the days of high 30s growth are permanently behind us?
That distinction, a temporary wobble versus a structural drift, is the multi-million-dollar question right there. We'll be watching very closely to see how that RPO translates to consumption in the coming quarters. Thanks for joining us for this deep dive. We'll catch you next time.